How do you do, ladies and gentlemen? It's Seth Briefs for All today. It is the beginning of the earnings report season, and it's going to be a sea of red ink. We have reporting out today the 14th Citigroup, J.P. Morgan, and the expected losses are 56 and 29% respectively per share. It's going to be bad. And the reason it's going to be bad, of course, is that they have a tremendous amount of bad loans, non-performing loans. The pandemic has caused businesses to shut down. Carnage is rife. Millions have been thrown out of work. Trillions upon trillions of dollars have been shoveled into the accounts of American corporations and American citizens and around the world. It's true for Europe. It's true for Japan. It's true for places literally all over the world. And the reason it's important for us is not only to try and trade, J.P. Morgan and Citibank and all the rest of them this week. We've got Alcoa, the Aluminum Corporation of America. There's a lot of aluminum in those planes they're not making anymore. eBay is going to do tremendously. Goldman Sachs likely to do well. Microsoft, Netflix, of course, is going to go through the roof. People are glued to their couches, so they're watching a lot of TV. So they're going to do well. But the reason we feel it's particularly important at this time is to take a look at the indices because, as you're probably well aware, there's been a fairly delusional uptick in trading. This is the beginning of the pandemic here. This is the S&P 500. It's largely representative of practically every major stock index in the world. Here it is here, goes down here to pandemic in the darkest middle of March, and that is the market. The pandemic is still in the toilet. I don't want to go into those statistics. But the remarkable thing, and all that I'm trying to say to you now, is that these falls, as steep as they are, as these rises, as steep as they are in the back of those falls, is in the face of growing and increasingly widespread sickness caused by the pandemic. And yet the stock market seems to feel that the worst is behind us. Well, we don't think so. We think that the worst is well ahead of us. And one of the reasons we think that is not only because we're all junior epidemiologists now, but because this pattern is largely similar to the pattern displayed in the Dow Jones Industrial Average following the Great Depression of October 1929. The first quarter is down like this. This looks like October to December of 1929. This looks like Q1 and Q2 of 1930. And what happens afterwards is a steep, long decline that goes well into 1930. It goes well into 1932. 1930 and 31 are the deepest, darkest parts of the depression. Even 32. By 33, there are signs that things are turning around a little bit after, the New Deal starts to kick in and they start to spread the wealth around. But we think, and we're not the only ones, that this is likely to reverse sharply and reverse soon. And we think that's going to happen starting this week with the cavalcade of disasters that is that earnings report for Q2. Remember, Q2 takes place entirely within the confines of COVID-19. So Q1, well, people didn't, the sensibility of how deep the damage was not there because it was only the last month of Q1 that was affected, and even that, those reports are highly lagging, and so Q2, which we're starting to get out now, is going to just be a sea of bad news, and we think that sea of bad news is going to impact quite negatively on the stock indices. So we can see today a little bit. Yesterday the Dow took a steep drop down. The Amsterdam down. This is only a 15-minute on the Johannesburg. The DAX is down. Now the Nasdaq isn't, but the Nasdaq is the only exception to what I'm saying now because the Nasdaq is the only listing that is actually justifiably the runaway train that it is. The Nasdaq is filled with tech stocks that are doing wonderfully out of the pandemic, and so therefore is likely to rise. But so what I'm saying with respect to the red ink that's going to be spilled in the earnings report season, as it's going to spill onto these indices, does not apply to the Nasdaq because that is justifiably high. So therefore, we're painting this picture of doom for the stock indices, sell the Nasdaq up. The Nasdaq is likely to continue up because we're going to have Netflix and Facebook and Amazon and Google, and these guys are going to talk about runaway train. This is going to be vavoom. So we want to make sure that Nasdaq is the exception that proves the rule. Now we do, as a backup, as an enforcement to this idea that markets are going to have another big sell-off in the face of what's going to be probably a lot of panic and fear this week. We want to take a look at one of the major indicators of that panic and fear, gold. Here is gold at the bottom. This is a monthly chart. This is my mistake, ladies and gentlemen. Excuse me one moment. Here we go. Here's the depths of the beginning of the pandemic worldwide. People are panicked. Gold is where it had been for some time. It goes from 1460, we'll call it, to 1800. And 1800, and has been sustaining at 1800. In fact, what I'd like to do is show you. This chart is probably well familiar to most of you. This is 2011, where price gets to 1920. Was it right there? 1912. No, this is it right there. It's 1920. And so that is a psychological milestone that markets naturally want to pick off again. It's a human characteristic. It's a common trait. So we've got a lot of momentum here. This is average volume. And pardon me, ladies and gentlemen, I'm broadcasting from the harbor. Here is the volume is tremendous, driving these tremendous price rises. So you can see that this sentiment is quite strong. It's standing above the 200-day moving average, the 200-week moving average, the 50-week moving average, and the 20-week moving average. So that is on very, very high, though declining volume. It's still, even this volume here is well above the average volume prior to the pandemic. So gold is indicating a lot of strength, and just the last thing we'll take a look at is some of the currencies, because there are currencies on the move, and the strong currencies are the yen. Now this is dollar yen. I just want to point out, it would appear from here, well, it doesn't appear, from the beginning of the second quarter, it's not doing anything. It's just asleep here, and but you notice it fell down to here, and it's regained about half its value. So the yen, as it continues on its way down, is going to become stronger, and that is the trend. The yen is going down. The yen is becoming stronger, as is the Aussie, and those are both against the dollar, of course. This is Aussie dollar. The former one was dollar yen, so this goes up. It means the dollar weakens, and yes, here is the drop. Well, the dollar is in a decline from before that. The dollar is getting stronger actually before the pandemic. Here's the pandemic. The dollar strengthens strongly and then weakens greatly against the Aussie. So you got Aussie dollar strong, yen strong. Cable isn't doing much of anything, nor is the euro. So you've got two good currency trades. The markets are likely to weaken. Gold is strong. Let's take one last quick look at the oil. Oil is falling because, again, oil is largely a function of. Let's get a more drilled down chart. No, oil is still rising. No, yeah, it's fluctuating between 40 and 39. So that's oil's not doing much of anything. I think, if I'm not mistaken, Brent will give us the same picture. Let's take a 4-hour enlarged. Yeah. 39.60, 43. It's got a $5. It's a little more action there, but tight. No, it's really not. It's 41 to 43. Tight action, no real decline in price. So oil is a sleeper. Gold is up. Silver is up even more pronouncedly than gold. So there's a flight to cash. There's going to be a liquidation. There's going to be sell-off in the stock markets. These earnings reports are going to frighten the death out of investors. Get your clients to either be short the indices or do nothing. If they decide to be long for any lame brain reason, they're going to have to keep their stops really tight, and they're going to have to monitor those trades like hawks because the market's going to be fast. It may pass them over and not fill their order, and suddenly a stop that they had set for a small loss now has suddenly become a big loss, and they're going to have to fight hard to be able to get out of it, or pray to Allah that it comes back. Either way, it's going to be a one hell of a ride for those with the stomach to handle this. So make your clients aware of this. Let's make some money today. Bye-bye.